You're listening to The Dealmaker's Edge with AY Strauss, diving deep into stories behind commercial real estate leaders. Hello, everyone, and welcome to The Dealmaker's Edge. Today, we're delighted to be joined by Cory Elbaum, who is Managing Director at Angelo Gordon in the real estate group. Angelo Gordon is a leading privately held alternative investment firm. And at the firm, Cory helps manage and oversee all the real estate activity in the tri-state area, leveraging his 20 years of real estate experience to help him identify and pursue opportunities. Cory, we're really excited to have you on, and thank you for being here today.
Yeah, thanks for having me. Appreciate it.
So you are a busy man. We may as well get right into it. This podcast is really targeted for people up and coming in the industry. Maybe you could talk about how you got to where you are now before we get into what you're doing today. Maybe start from, and you went to Michigan. Maybe talk about your career paths a little bit.
Yeah. I wish there was a really interesting story to that, but actually I fell into it, to be honest. When I graduated Michigan, I was a political science major. I went to work, I actually worked for Henry Kissinger for a couple of years. And then I ended up in the kind of traditional investment banking path. And if anyone remembers 2002, technology investment banking was not exactly the place you wanted to be. It was, tech wreck. So that stint ended and I was trying to figure out what the next part of my career looked like. And I happened to be in Ann Arbor and I ran into an old managing director for my investment bank and he said, "Hey, I have a friend who's got this real estate company in New York and he's looking for a guy and I think it'd be interesting." And I took a big step back in terms of compensation and position and said, "Let me get a start here." And I went to work for a company called Crescent Heights. And I kind of credit the principals of Crescent Heights for giving me a shot. And I was there for a couple of years and then moved over into another operating company called Thor Equities. And I was there for a long time and ended up running their acquisitions department. I was there for almost 12 years. And then from there, moved over to the private equity side. And it's been great. I spent a couple of years at Dune Real Estate Partners and more recently at Angelo Gordon. It wasn't necessarily something that I thought about much. It just came to me. And, I feel very fortunate. It's a career that I love and the opportunity to kind of see and feel the real estate is really interesting, coming from doing tech banking where I didn't have a technology background and I had no idea how any of these products really worked. It's certainly been a nice transition.
Yeah. And I know your operating experience on the company side is definitely extremely valuable as you're underwriting these deals and you're partnering with sponsors, et cetera. And you definitely have a narrow market in some ways, but incredibly deep and vast market in that tri-state. There's so many deals to do. So day to day, I know you're juggling a lot. Maybe you can walk us through sort of like a day to day overarching theme for you. How much are you pursuing new deals? How much are you talking with sponsors on existing deals? Sort of walk us through, almost a day in the life, not with much, but big picture. People get a sense.
Yeah. So I'm responsible for the tri-state and Angelo Gordon. We're set up in kind of these regional deal teams. And I was hired to move over and kind of cover the New York, New Jersey, Connecticut marketplace, which was attractive. In my previous life, I was trying to cover the entire country. I found that to be, it obviously creates a lot of opportunity, but you're a mile wide and an inch deep, and that is difficult. The vast majority of my transaction experience had been in New York. So flying around the country in some of my previous roles, it's like that joke, if you don't know who the fish is at the poker table, you're probably the fish. And so when you fly into a new market and you're trying to uncover opportunities, there's probably somebody locally that knows it a heck of a lot better than you do. And I see that happen in New York time and time again. So the opportunity to come to Angelo Gordon and kind of narrow the focus has been a really interesting thing for me. I feel like I would say New York City, I generally feel like I know every building and every owner. And so that creates a lot of opportunity for us to kind of uncover unique things to do. So I cover the market with one other guy, and our days are generally consist of we're managing our existing partners at Angelo Gordon. The structure is kind of cradle to grave. So we're buying something, we're seeing it through the execution and through the disposition. So we do have quite a bit of asset management that we're responsible for. And then it's really trying to identify new partners, new strategies, and where we think the opportunity is. So I would say it's a pretty good mix of trying to create new deal flow, as well as trying to make sure that our existing assets are performing and we're doing all the right things there. So it's a pretty good mix.
Wonderful. I know that there's some sponsors listening to this right now. Obviously, the economics and the underwriting and the fundamentals of the deal are what they are. But maybe you could talk for just a minute on the intangibles that a sponsor might bring to you that you say, wow, this is somebody I want to do business with. What are some of the most successful sponsors you've seen
The nice thing about Angelo Gordon and the way that we think about it is that we're not necessarily just looking for the most experienced and established sponsors. We've had a good history of funding newer, younger sponsors that are, kind of peeled out of larger organizations. So we're pretty open to a lot of things. I would say number one is really having a focus and understanding your asset class, right? I mean, that's going to be most important. And then just being a really good deal hunter. And, one of the things that I've learned in my career is that, kind of subscribe to this Wayne Gretzky school of real estate. He wasn't the fastest guy or had the hardest shot, but he always knew where the puck was going and understanding where things are headed. And if you try and look at things when you're a value add investor, if you look at what's happening today, you might not see the opportunity. You kind of have to have a view on what's going to happen in the future. And I think that's what we look for in our sponsors is what is their unique angle? What is their unique approach? How are they thinking about things differently? If you want to be a core investor, you look at the real estate, you say, okay, like this is solid. We think we can maintain cash flow and tomorrow's going to be a better day. But when you're trying to create tremendous value in an opportunistic vehicle, you really have to have a view towards the future. And I think learned a lot about that when I was at Thor. We took a view on certain markets and we said, given what we're seeing in the world, we think rents here might be $100 a foot, but tomorrow they're going to be $400 a foot. That was obviously a very good strategy in certain markets. So we're looking for sponsors that have that kind of unique edge and view of the world. And then just the ability to execute, right? I mean, real estate always comes down to execution. You can have a great idea, but you might not be able to execute. So we're looking for folks that have experience in execution or we believe can execute, and we might start small and grow with them. We recently funded some younger sponsors who were kind of trying to start their own thing, and we gave them a deal on their platform. And we said, go out and let's try and find stuff. And we kind of have exclusivity on their deal flow for a couple of years. And, they're young guys who are showing their ability to perform. And we like that business model.
Yeah. And very symbiotic too, I might add. You get deal flow, the balance sheet strength, and all the other skills that you bring that they could never possibly bring in-house. So it's amazing. And maybe just on a platform level, they obviously have you, in the trenches with them, but maybe just broadly for broad brush strokes, you can describe how a platform like Angelo Gordon would be separated from the pack as, say, another potentially institutional partner for an up-and-coming sponsor.
Yeah, look, I think the thing that separates us is sometimes you look inside of these large capital providers and you find a lot of kind of investment bankers. And I think Angelo Gordon has separated itself in that we are truly real estate folks. And me coming from the operator side, I think that was one of the value adds that I was able to bring is we really saw things, as I speak to a lot of young folks in college now, people are looking for jobs. And I say like, the closer you can get to the real estate early in your career is going to be critical. And you hear from large families and they stick their kids in property management or in the building, maintenance, like really trying to understand the bricks at the very basic level is critical. And so I think you have a lot of folks at Angelo Gordon, in particular, my portfolio manager was an operating partner of Angelo Gordon. He was on the execution side and he sold a bunch of stuff. And we said, why don't you come? This was way before I got there, but they said, why don't you come join Angelo Gordon? And now he's running real estate group. So he's got real estate experience, development experience. And so we understand the real estate, at that level. And I think that's an important note is if you're young and trying to break in, trying to get as close to the real estate as possible early in your career is important because it's never exactly what you think. Things are always a little bit more difficult. They always take longer, more expensive. And I think that's one of the things that a lot of folks in our position do is we underestimate the complexity of execution. And if you're close to the real estate, you'll learn that really early on that there's a lot of moving parts and a lot of things that need to be solved for in order to have a successful outcome.
Amazing. And I got to pay a big compliment here because normally I have to tease that out of people. What would you tell to somebody up and coming in the business? You're just giving it to me straight. So you're making my job much easier.
It's happening more and more lately. I'm at the age now where I have a lot of friends whose kids are sophomores or juniors in college, and somehow real estate is very high on the list of things that they want to do. And so over the last couple of weeks, I've probably had a dozen phone calls with, rising juniors or rising seniors looking for advice and help in trying to figure out, how to break into the business. I've had some practice.
Amazing. And it's good you give that time. I'm sure somebody gave it to you back then, as you described. So it's just part of the cycle. And I know people appreciate that a lot. Of course, the sponsors that sort of are trying to see around those corners in the tri-state, I mean, New York, New Jersey are much, much, much different markets, obviously. Connecticut's own market. What are some of the themes you're seeing today? Forget about fundamentals because those are changing like so bizarrely fast and no one can really make sense of much in real time. But the concepts and themes you're seeing for long-term value creation in the markets you're serving, I'd love to hear about that.
Yeah, I mean, it's becoming harder and harder, right? There's a tremendous amount of capital chasing opportunities. There are certain asset classes right now which have obviously fallen out of favor. So, if you speak to many of my competitors, everyone is kind of talking beds and sheds as a majority of what they want to do. It's industrial and residential. Office has obviously become challenging in many environments. Some are stronger than others, but there's a tremendous amount of stress in the office market right now. Figuring out how to approach those other asset classes and find opportunities there is what we've been spending our time on. And, it takes a lot of work. And, we had a meeting last week with a potential partner, and I think this is critical. And that is that, some of these deals, this partner is a successful industrial developer. And he told us on average, it takes 3 to 5 years for a deal to make. Right. And so it's putting in that time and establishing relationships with potential sellers. A lot of times it's families. They don't really know exactly what they want to do. So it's really, to me, it's about hunting the deal and establishing that relationship that's creating the value today, because we're all focused on very similar things right now. There's a lot of folks like me with a lot of capital, and, in some sense we are a commodity. I like to think that Angelo Gordon separates itself a little bit in that we're able to move a little quicker. We understand that the operating partners that are able to establish those relationships and spend the time and uncover unique opportunities, it's these sponsors that are able to go out and create opportunity in a place that may not be obvious at the time. In terms of themes, like I said, I mean, there's some things that people are talking about. I know when we were in Miami, we talked a lot about the office to residential conversion. A lot of people are talking about that. I think there's definitely something to do there. And there's a couple of groups doing some quite large ones right now that have been in the news. I think we'll see a little bit more of that. I think we need the city to step up and participate in that process and maybe create some kind of new tax incentive. But there are certainly many, many office buildings that are both functionally obsolete and, in my view, will never lease in their current state. And so those will probably need to be rethought. And in order to do that, in order for that to make sense, I think we're going to need some kind of support from the state. So that's one place. And then, we've seen a lot of groups pivot into these more esoteric asset classes. And that's something that I think we've been open to. And, you hear all the different 3-letter words, BTR, SFR, IOS. So like, all of these new asset classes starting to show up, industrial outdoor storage, built to rent. We've opened up our eyes to some of these other esoteric asset classes, and we think that there's an opportunity there. So we're seeking out partners that are, understand that there's new markets opening up all the time. And even life science is obviously a thing. So but you have the 4 major food groups. We view office as kind of very low on the likelihood scale of getting things done. But, all those other asset classes, and we're reasonably bullish on retail. I have a strong retail background, and we've spent quite a bit of time trying to figure out retail. And we're looking at one large retail deal right now, which we think is quite interesting. So we don't close ourselves off in any real way. I think it's important to note is in terms of thinking about real estate and, cycles, there are times, and I've seen this in my career, and, I work with a lot of folks who haven't seen cycles, and I think it's important to study the cycles. And there are times when you want to buy a market, right? You say, okay, like this market is going to change. And then there are times when you want to buy buildings. And I think obviously, there was a period of time where if you bought a building in Nashville or you bought a building in Austin, it doesn't matter whether you were good at execution, bad at execution, like you made money, right? Like you bought the market and you made money. And that is, and then even in some markets, right? I mean, if you bought Soho 10 or 15 years ago, like that building is worth more today than it was then. I mean, we probably saw a little bit of a dip, but we were always looking at, we were trying to focus on, okay, is this the time to buy a market or a submarket, or is this the time to buy a building? And I think right now we are probably in that period of time where it's buy a building rather than a market, because things are so uncertain. The capital markets are very unstable. We really don't have a good feel for, where the debt capital markets are. So we're very selective. We're being thoughtful, but there may be a period of time in the next couple of months where it's like, okay, let's go and buy the market. But I think it's important to differentiate those, and you really have to sort of study cycles and understand what has happened in the past. And my career over, 15 or 20 years, I've kind of seen 2 of those cycles happen. Obviously we had GFC, and then we had, kind of COVID, I guess. And now we're in this kind of recovery, but potential maybe depressionary environment. So we're being very mindful in terms of what we're doing.
Very well articulated. I don't think I've ever heard it spelled out that clearly, but buy a market, buy a building. I guess in any market up or down, you can strategically lay that out. Have you seen, everybody's talking about the distress, and it's just such a, almost a foolish word at this point because it's so situational per building, per sponsor, and everything else. But on a macro level, the types of opportunities you're seeing today, how are they looking different than say even 3 months ago at this point? I mean, what are the
Yeah.
conversations?
I mean, I don't want to say everybody, but many of my counterparts that are in similar seats, it seems like everyone is talking about trying to generate equity type returns on a more debt type risk adjusted basis. So we're looking at a lot of pref and mezz. We're not sure that the equity makes a lot of sense today. So we've spent a lot of time talking to the market and letting them know that, while we're an equity fund, we can create return through mezz or pref and be in a more protected position. There's definitely distress in the market. We're trying to figure out how to make sense of that. But yeah, I think if you look at deals that were financed in the last 3 to 5 years, those interest rates are now double. And while you might not have a real estate issue necessarily, you have a capitalization issue. And so that creates opportunity for guys like us. I mean, you might have a multifamily deal that was financed 5 years ago with floating rate debt. That debt is now coming due. It's not replaceable. The income might be, but you can't replace that debt. And so you end up with a capitalization issue where you have to fill a hole. And a lot of these sponsors don't necessarily want to come out of pocket with that capital. So we think that there's an opportunity there. And that's not necessarily real estate distress. That's capitalization distress. But then you've got real estate distress. I touched on it a little bit when we talked about the office market. I kind of view the office market as the haves and the never will haves, right? It's not the haves or have nots. Those have nots, I think, could be dead forever. And so if you have one of those will never haves, like that is a big problem. And if you're talking to the equity, you're probably talking to the wrong guy today. The lenders have some very difficult decisions to make. Do they want to own these buildings? Are they prepared to fund capital into them? In many cases, there is no bid on the leasing side. And these buildings require tremendous amount of capital, both carry and lease up cost. And like I said, I think some of them will never lease. There are certain submarkets in New York that I view as extremely problematic. So there's distress there. And there are going to be many, many stories over the next, 12 months where lenders are going to have to make some pretty difficult decisions. And there's going to be a lot of value wiped away on the office side. But like I said, we're going to focus on the places where we think there's a capitalization issue. There may be an opportunity on the distress side to play in some of these properties where we think the basis just feels so good, but there's going to have to be a unique story. And, if we think about office, think about is what differentiates this. And sometimes, you could end up in a value trap where you just think this office building is so cheap, right? Oh, it's $200 a foot, but that $200 a foot could become $500 a foot. And then it doesn't feel so cheap anymore. So we're going to try and avoid those value traps and focus on places where we think it's more of a capitalization issue than anything else.
Amazing. Thanks for laying that out. Very, very clear. A question not related to real estate directly, but indirectly. How are you managing the day-to-day mindset? We call this the deal maker's edge. So you're a deal maker. You've got a lot going on, a lot of pressure, navigating a lot of different dynamics. We talked a little bit about that offline. Maybe you could share how you sort of manage your day-to-day stress from an intense role that you're playing every day.
Yeah. I mean, it's, we're back in the office. I live outside the city, so I'm commuting every day and try and do healthy things, right? Keep exercise in the routine, trying to do things that keep your mind off work. I'm a big New York Ranger fan and season ticket holder. So I find myself at the Garden quite a bit. Spending time with my kids there is fantastic. So trying to separate the two, and we're all very connected and constantly on our phones. And so once I leave the office, check in and make sure that nothing is blowing up, but try and spend a little time away from it and have a clear head is important. Love to say, like, I wake up at 6 and I meditate, I work out for an hour. Like, that's not the truth. I mean, I do try and get in an exercise pretty regularly, but it's about having that kind of balance, I think, is important. And I think at Angelo Gordon, they focus on that. And it's good. They sent around a survey last year, just kind of year in review. And, do you think you have a good work-life balance? And I think companies are more and more attuned to that these days. And I think that's one of the good things that came out of COVID. I have been in situations where it was like, you're in the office 5 days a week. You're there from 9 a.m. until 8 p.m. And if you're not doing your job. And I think we've come to accept that we could be productive on calls like this, Zoom calls, remote. And so, I think that's become a little bit of a kinder, friendlier workplace, like understanding that family is important, to having opportunities outside of work to free your mind a little bit, I think is good. And I think we do a pretty good job of that.
100%. Last question. Anything else you would have liked me to have asked, but I did not, that we didn't touch on? Think we need to cover?
I don't think so.
Well, I guess with that, Cory, we can wrap. I want to thank you again so much for taking the time out of your busy schedule to be on here. I know people have learned a lot. I learned a lot, and really excited to watch what the next 6, 12, 18 months brings and beyond. It can flourish.
Should be interesting. Yeah. Thanks a lot. It was always good to catch up, and we should do it again at some point soon in person.
Awesome. All right, Cory, to be continued.
All right. Thanks. Take care.
Thank you for joining the Dealmaker's Edge. Don't forget to follow us on your favorite podcast platform. Give us a 5-star rating so more people can follow the conversation.